Hey everybody, Real Estate Ninja here. I hope you're doing well. We're going to talk about adjustable rate mortgages and what's going on with them as opposed to 30-year fixed rates and how this exact same scenario played out in 2006, 2007. It's getting me really excited, but also very afraid for people because I think there's a lot of people that are falling into a trap. People that have seen the buildup in real estate over the last 2 years, and they've got that FOMO, the fear of missing out, and they're about to dive in because they're seeing the first signs of weakness in the housing market. And that sign of weakness is evident in drastically falling sales numbers, right? So where I did a video a little while ago about San Diego, and guys, by the way, if you're new to this channel, this is not the Economic Ninja channel, this is the Real Estate Ninja. Please hit the subscribe button because I am going to walk you through this collapse in housing, and I'm going to help people obtain real estate, but the smart way, the wise way. So it's, I did a video on San Diego and their sales fell 41%, I believe, last month over month. And that is a drastic drop in sales. Well, we're seeing that same drastic drop all over the country, in Phoenix, in Austin, in Miami, all over the country we're seeing this. And I believe you're going to see it get even worse, right? Well, what is the first thing that happens during these times? Well, see, banks need to make money. They need to loan money or they don't make money. And the biggest way that a bank makes money is through mortgages, right? And so back in 2005, as the Federal Reserve was raising rates, going up and up and up, about 1/4% every month or 3 months, it was called the dot plot plan, banks were increasingly seeing their sales decline in mortgage refis. So they were not bringing in as much money, and they had to figure out clever ways of bringing in money. Well, the reason why they were seeing less sales, less refinances, was because they were raising their rates along with the Federal Reserve, right? Because why would you even do mortgages if you just might as well just keep your money at with the Fed, and it's secure money. So if it's going to have added risk, i.e. loaning it out to someone that might not pay their money back, someday, like in a mortgage, they're going to add, that interest rate is going to keep going up. Well, what they had to do is they started to turn to other loan products and they started to discount those. And the bond market does it for them, really. But in terms of mortgages, they would sit there and they would offer better packages on like 5/1 ARMs, things like that. The 5/1 ARM product came down, the 3/1 ARM, the 7/1 ARM. And right now we are seeing that. Back in 2020, the 5/1 ARM, the introductory rate was literally right on pace with a 30-year fix. And it would make no sense. Why would I do that, right? The bond market was telling us that, hey, they were closer. But now, with interest rates and mortgage rates up so significantly, I think today, as of the recording of this video, a 30-year fixed is between 6 and 6.25%, right? And that's with 0 points. Well, today, a 10/1 ARM sits at 5.1%, and a 5-year ARM sits at 5% even. So literally over 1% difference. And when you look at that on a percentage basis, that's like, what, 17, 18% less interest you're paying during that 5-year term. And that is a massive difference. So a lot of buyers are, I believe, going to start diving in, or they already are, as a matter of fact, because since January, we've seen an uptick of 300% more adjustable rate mortgages being, taken out, as opposed to full 30-year fixed mortgages. And that was actually in January. In January, we saw a 3-fold increase. And that was as rates are going up. I can't even imagine. I haven't been paying attention to those percentages now, but I bet you it's exponential. Totally dangerous for the economy. Why? Because a lot of people are getting in because they simply can't afford the higher rate. They cannot afford the fixed rate, and they just want to get in. And they're confused, and they're led down a primrose path, and I believe a deceitful path, by their loan brokers, because their loan brokers, usually, they're only in it for the money. They get paid if you get a mortgage, right? So they're telling you things like, don't worry, the Fed's going to lower rates. Why? Because more than likely, they have not been in the mortgage industry for longer than 20 years. And please, if you're in the mortgage industry and you've been in for a long time and you've seen these cycles, these interest rate cycles, please put down below what I'm talking about in better terms than what I'm saying, because most people don't realize that a healthy mortgage market sits between 7 and 9% interest, because that means that that the economy is healthy. See, the only reason mortgage rates have been so low since the year 2020 or 2001 is because the economy is not healthy, and it's been propped up. But that's about to end because we're going through a currency collapse. And so I believe there are a lot of people that are going to be misled down this path, and then they're going to think that mortgage rates are going to be lower in 3 to 5 years, and they're not going to be. And I think that is going to bite a lot of people in the butt. As a matter of fact, we're also seeing mortgage companies increase their points, especially for properties that they're, for rental properties, especially Airbnbs. I think the banks know what's coming and they're pricing in risk accordingly. The scary thing is I think that a lot of people do not know what's going on and they're being led down a path to destruction. And I want you guys to be careful. That's why I think you should always, if you get into a mortgage, it should be 30-year fixed, because then you've got the backing of that fixed rate to hedge yourself against uncertain times. Guys, I hope you got something out of this. If you did, please hit the subscribe button, hit the thumbs up button. Let's get this algo woken up. All right, guys, that being said, the Real Estate Ninja is out.